Hi guys, this is HT here. Hey, I wanted to quickly give you guys an update on how I use Pyfolio package, okay, to run optimization and also look at the portfolio performance. Okay, so this is just a quick performance review of one of the stocks that I was tracking, and I wanted to compare against the benchmark and see how it is performing. Okay, so Pyro Portfolio is a very powerful package that is created especially for finance folks who are running different analysis. So you can use this Pyro Portfolio. Finance, Y Finance. Also, Y Finance actually is a Yahoo Finance package that a lot of the people use in order to get the data, historical data. But Pyrofolio gives you an more analysis in terms of like how you can measure your overall portfolio performance. Okay, so first you need to download that package, so you can do pip install Pyrofolio reloaded. Okay, Y Finance. So I've already done that. I'm not gonna run this, but yeah, you just like click, run it, and you should be able to download it. Um, the other thing is that you have to basically import the Pyfolio for finance analytics and Y Finance for fetching stock data. Okay, so in order to do that, you have to use import Pyfolio as py, import Y Finance as um, you know um, YF. Okay, and then you fetch the data. In order to fetch the data from the Y Finance package, you use fy.ticker, okay, the ticker symbol, and then the history, okay, the start and the end date. So in this case, we are using basically last 15 years of data in order to do the analysis. So once you run this, you're going to get all the data in your all of the information about this ticker into the data frame. Okay, and then you can also look at the benchmark, which is SPY, for the same duration, and then put that over there. The other thing you can do is just calculate the bench returns. Bench return is nothing but the overall daily returns that you are seeing from your benchmark. In this case, it's SPY. So if you want to calculate that, you can use bench underscore returns equal to bench dot close dot percentage change. Okay, and then you can calculate the daily percentage change for the assets closing prices, which is returns equal to data dot close dot bcd change. Okay, that's going to be calculating the overall daily percentage change for the assets closing price, and then you can look at the returns, overall returns. Okay, so these are the returns that you're going to see. You can drop the NA values that have resulted from the percentage change calculation. The first row, returns equal to returns dot drop NA. Yeah, bench underscore returns equal to bench underscore returns drop NA. Okay, so that basically kind of drops all of the NAN values, and then you can align the two return series to ensure that they have the same dates for accurate comparison of your returns, bench returns. Okay, so once you have done that, okay, the only thing that you have to do now is use the Portfolio and get the function called create returns tier sheet. Okay, so tier sheet is the one that gets generated, which basically tells you everything about the overall performance of this particular stock, or various asset classes that you might have combined together. Okay, and looking at the returns of both of them and seeing like how the comparison is. Okay, so this gives you again a lot of plots for analyzing the strategy return, the benchmarks that creates the plots on a single figure, rolling returns, okay, rolling beta, rolling Sharpe, rolling pharma fringe, risk factors, drawdowns, underwater plots, monthly and annual plot returns, daily similarity plots, and the returned quantile box plots. So all of that information will be provided to you. Okay, only using the single query. So if you look at it overall over here, like this is how the um, the overall output looks like. Okay, so I'm going to go into the details of these output one by one. So let me just share my other screen, which I wanted to show you guys so that I can walk you through the process. Okay, so this is the first thing that you need to look at. Basically, it's nothing but, yeah, the overall portfolio performance sheet. Okay, Basically what it tells you is that um, what it tells you is that it looks at the overall performance of the portfolio, right? In terms of the benchmark. So if you're looking at the start date, end date, in sample months, out of the sample months, you have in sample, out of the sample, you have annual return, cumulative return, annual volatility, Sharpe ratio, Calmar ratio. So let me just talk through the whole, all of these performance stats, okay, one by one. So the first thing that you're looking at is obviously the start and the end date. So the start and the end date of this particular experiment is nothing but looking at the backtest analysis. Okay, so in sample months is nothing but the period in which the development and the fit and the calibration of this particular model happened. Okay, that's where basically the model was tested. Um, and the out of the sample months is the period in which you're not using it for the model development. You're evaluating the true predictive performance of the of a portfolio. Okay, so if you're looking at the returns, you're basically again figuring out of the sample months and seeing like how well it is performing in that particular month. Okay, in sample is where you're kind of strategically looking at in order to develop or fit the model. The annual return again talks about the compounded annual growth rate, which is CAGR, CAGR of the strategy. Okay, it takes into consideration how many years you have taken for your analysis. So in this case, it's 15 years. So we are looking at the CAGR for 15 years and then looking at the average return. Okay, which is again defined based on the annual return. Okay, you can also look at the hardcore cumulative return, which is nothing but a row growth for your portfolio. It is the total percentage gain or loss during the entire period. Okay, you can look at the risk and the volatility factor. So on the risk and volatility factor, you can look at the annual volatility, you can look at the max drawdown, you can look at the daily value at risk. Okay, so the annual volatility is nothing but the standard deviation of returns, which is annualized. Okay, it measures the return variability, not the risk symmetry. And you have the max drawdown, which basically looks at the largest peak to trough loss during the period. Okay, well, the max drawdown basically talks about the overall pain factor that you might have when you're looking at your portfolio, right? Because the drawdown is nothing but the loss in the overall value of your portfolio, but that's the time where you have to be very cautious in terms of what you're going to do with your portfolio. Are you going to add more into the portfolio, or are you going to take it down or sell? Okay, so this is definitely a pain metrics. The daily value at risk is the expected worst daily loss at a given confidence level, usually around 95 to 99%. Okay, so let's say if you're in this case, the value at risk is negative 3.6, which tells you that 5%, there's always a 5% chance that you might be losing more than 3.6% in a given day. Okay, does not tell you how bad the losses can go beyond that threshold. Okay, the other thing that you most of the portfolios look at, okay, is the risk adjusted performance. The risk adjusted performance can be looked at based on Sharpe ratio, Sortino ratio, Calmar ratio, okay, or omega ratio in this case. So we can the I think the most common is the Sharpe ratio, which basically looks at the total return per unit of total volatility, which is asymmetric returns. The volatility is nothing but the risk that has been associated, like industry baseline metrics. And then you have the Sortino ratio, which basically looks at the return per unit of downside volatility only. Okay, better than the Sharpe when returns are skewed. And then you have the Calmar ratio, which is basically return per unit of maximum drawdown. Okay, just common in CTA, macro, and the trend following strategies. And you have the omega ratio, which is probability weighted gains versus losses related to the threshold. Okay, so I think the most important thing is the Sharpe and the Sortino ratio, which basically talks about the overall return on a per unit volatility, total volatility, and the downside volatility basis. Okay, so those are actually important ones to look at. You have distribution shape metrics like skewness, kurtosis, tail ratios. Okay, so skewness, if you have a positive skew, which basically talks about the more how frequently you have small losses and occasionally big gains. That's your positive skew. Whereas the negative skew talks about the frequent small gains and the rare big losses. Okay, Most option selling strategies have negative skew. Kurtosis is basically talks about the measures the tail heaviness. Like if you're looking at kurtosis of close to 3, then it's a normal distribution. If kurtosis is greater than 3, then you have fat tails. High kurtosis is crashers. You have the tail ratio, the ratio of upper tail magnitude to lower tail magnitude. And then you have stability and consistency. Stability is the correlation between cumulative returns and time. If it is close to 1, then you have smooth, consistent growth. If it is close to 0, then you have noisy, erratic equity curve. Often computed as R square of log equity versus time. And then you have something called the risk exposure matrix, like alpha and beta. Okay, alpha means you have excessive return, which is not explained by the benchmark. Beta is nothing but your sensitivity to the benchmark movements. Okay, so those are the metrics that you will be basically looking at on whenever you're looking at a portfolio. The other things that you can see is, again, like how the overall out of the sample returns looks like on a weekly basis, monthly basis, or a daily basis, and you can see like how the volatility is being captured across these different time frames. Then you can look at the daily returns, okay, across the whole time frame, and see like how much of a variance are you getting it. You can look at the monthly returns, annual returns, and distribution of monthly returns. Okay, this is also a very important like chart to look at, because it can tell you like in terms of how overall year, like where does volatility exist the most and where it doesn't. Okay, so that gives you a kind of an idea. And you have the annual returns, and then you have the distribution of monthly returns. Okay, and you can also look at the rolling portfolio beta to close, a rolling Sharpe ratio on a 6-month basis, a rolling volatility on a 6-month basis, top drawdown periods. The one that are marked in a gray at the back is actually showing you like where the drawdown is happening. Okay, and then you have the drawdown underwater plot. So this one is actually pretty nice, because it tells you like what all are the time frames where the drawdown was the maximum. Okay, especially for your portfolio. Okay, so these are like very important charts to look at whenever you're looking at a portfolio. I think this gives you an idea of like how most of the portfolio managers or investors or investments advisors are looking at the portfolio and trying to gauge performance, okay, against the benchmark. Okay, so these are like important factors or performance metrics to look at. In the next video, I'm going to talk about combining different asset classes together and then looking at the similar kind of performance across all of these different, like when you combine all of them together to see how it performs against the benchmark. Okay, see you in the next video.